Welcome to the show. Hey, it's Les Solgrove with Simply Des Moines. This is the year in review state of the market annual report. It is coming to you on week 2 of 2023. So this will be the weekly show as well. So this is a long one. And I want to just give you a heads up that this video will be chunked out on DesMoinesMarketValues.com with separate links to each of the sections as I go over them today. So you can watch either the entire show at one time, or you can go to DesMoinesMarketValues.com and go to the year-end show reports, and you'll be able to see each of these sections. They're all going to be about 10 or 12 minutes in length in each section. So sit back and enjoy the show. Let's get started here. Let me get my slides going. There we go. Let's start off here. First of all, this is the market at a glance report. This is the one report that I put out it automatically populates every week that I put out the stats. And I don't show it very often, but it's just kind of a nice reference chart. It shows you kind of what happened in all of the 5 categories, all properties, and then the 4 subcategories, and then broken down by for sale, median list price, sale pendings, days on market, etc. And it's just kind of a nice poster, as it were, of a recap of 2022. So as we move into the overall market report here, one thing I want to explain up front is that this report, much of this report data is based on December 31st. It's like a moment in time, or a snapshot in time. And so keep in mind that for example, closed transactions, we see those number of sales increase after the first of the year that get accredited back to 2022. So the numbers I'm going to report are based on December 31st, but in reality, we actually have more numbers that came in after that, and they will continue to come in within the next 2 or 3, probably a couple more weeks. We'll see them at a pretty good pace, but you'll kind of get an idea of what I'm talking about here. So let's talk first about the overview of the market. And this again is based on that December 31st date. On that date, we had recorded 17,927 homes that were added to the real estate MLS system during 2022. So 17,927 homes were actually added to the MLS. Of those, 12,484 actually accepted offers to purchase on them. Now, there are situations where home sales fall through, and so they would come back on the market. We talk about back on market here in a little bit. There's also sales that occurred in the fall of 2021 that maybe didn't close until the first quarter of 2022. For example, new construction is a good example of that. So if these numbers don't look like they add up, it's just because we're dealing with a moving target, as it were. And again, the closed sales we recorded as of the end of December was 15,482, and that number equated out to just over $4.6 billion in closed sale volume. That's down just a little bit from 2021, but it's pretty darn close. And I'll talk a little bit today about some of the nuances of how we can actually have equal volume of sales, but our number of sales are down even when inventory appears to be growing, and why it is actually growing. We get into that a lot today. The National Association of Realtors puts out an economic impact report each year, and they basically they do an analysis, and they say, what is the economic impact of a single real estate sale in a single real estate market? And they break this down by region. So this is in the Midwest region, and they state that $70,500 is generated every time a home is sold in the central United States market. So this central region here, and that $70,000 is broken down by direct income generated from real estate industries. So real estate sales, commissions, for example, lenders and appraisers being paid on transactions, more filing fees, all the costs associated with a home sale. Basically, they're saying that of that $70,000 impact, that's around 18 or close to $19,000 is generated. So if you think about all the employees that are working up and down the line in the mortgage divisions and the closing companies and the title companies, the appraisers, escrows, all those, that's that almost $19,000 portion of that 70,000. What's the first thing that a homeowner does when they buy a home or when a seller's getting ready to sell their home? They spend money on that home, whether it's fixing it up or buying new appliances. They're saying that of that 70,000, on average, about $5,000 is spent either on the processing side of setting up the house to sell and or combined in the purchase afterwards. So there's 5,000 of that. The multiplier of housing related expenditures. So if you think about the Home Depot, for example, um, this is one of the areas where homeowners will go off and they'll purchase a home, and then they'll spend over the next period of time, they'll spend time out there, maybe replacing carpets, and that then has a effect down the line of, for example, carpet companies, producing more material, drywall companies, paint. If you think about it in the lines of landscaping and things like that. So there are a multiplier of related expenditures, and that's a pretty good number because people buy a home, they tend over the next period of year or so, they tend to spend quite a bit of money on their homes, making it the way they want it. New construction also has a component into this as well. The cost of materials and everything, as well as the labor force required for new construction, subcontractors, and down the line. Those are all making into that $70,500 economic impact. And so you do the simple math of 15,482 times 70,500, and you'll see that in the Des Moines market, if we apply that same 70,500 economic impact, we've generated almost $1.1 billion of total economic impact in the central Iowa real estate market overall from the last year. So that's, real estate pays its way. It really is a large part of the gross economy in the grand scheme of things. So that's kind of what this graphic shows. Looking at the last 5 years of sales volume versus the number of sales, and I'm going to talk in detail here as we get into this a little bit about our number of sales and the sales volume, but you can see that we actually had a down year when it came to number of sales, which is represented by the red line, 15,482 versus 17,473 a year ago, so almost 2,000 fewer sales than 2021. However, our sales volume, again, like I said, is 4.6 billion versus 4.8 from 2021. The interesting part of this is if we stretch this out and look farther back, even going back to 2009, this is why I like old data, because it gives you a good trend line to look at. And you can see that prior to COVID there in 2019, we were on track, kind of a plateau period there, and I really believe we were at a point where our market was going to basically reset. We were going through these cycles. We talk about cycles in a little bit here as well. But I felt like 2019 was the year that the real estate market was going to start a brand new real estate cycle, and we were going to start moving back upwards again in a lot of areas. But COVID came in and really kind of jump-started that. And you can see that the number of unit sales jumped from 14,000 almost 300 to 16,700 in 2020, increased again in 2021, and now we're back down again in 2022. But if you look at that trending, though, it's not too far off of maybe where we would have normally been had we not seen a COVID year. Other than pricing, obviously, it was up. So speaking of pricing, let's take a look at the pricing modules. And one of the things that I follow each week is I update an automated valuation model, an AVM, of a specific property. And I've been tracking this for, gosh, I think I've been doing this one on this property for 5 or 6 years. It's basically, it's a typical Des Moines 2-story home, existing home. And I've tracked the overall AVM, or the automated value of that property over time. And this isn't quite the same as market values or increased in appreciation of values. It just kind of says, how much is a home kind of worth on the street without putting it on the market over this period of time. And you can see back in January of this year, week one, this particular property was coming in around $290,000. And it kind of peaked as we went into the last quarter, beginning of the last quarter of the year, at around 325. And so let me just kind of show you with the next slide how that's kind of broken down. Now the dotted line, and you'll see right here, is the CMA, or the market analysis. This is a valuation that I, as a realtor, would put on a property. And the reason why it looks like it's kind of in chunks there, I do this every 30 days on this property. So therefore you can see the changes only happen in about every 4 or 5 weeks there. And the market analysis, along with an appraisal, for example, those would be considered the two most accurate valuations of a property. Probably an appraisal, obviously, much more accurate, but an appraisal is looking to essentially confirm what a buyer and seller agreed upon for a mortgage lender. A market analysis is just giving you a good idea of what a home value is in a marketplace at any point in time based on previous sales. Now the 3 AVMs that I use also, that I compare this to get this average, is CoreLogic, which if you've ever borrowed money for a home improvement loan and the lender said, oh, we're just going to look online and make sure your value is good and not send an appraiser out, this is probably one of the companies that have provided that AVM for you. A lot of times in the recent years with COVID, we were seeing no appraisal properties. It didn't mean they weren't appraised. It just means they didn't send an appraiser out necessarily. They used an AVM. They said the analytics show that your home valuation is within an acceptable range, and therefore we're going to not send an appraiser out. We're kind of getting away from those, I think, as we move into out of the COVID era, but we still see those on occasion. That's the green line. RPR is Realtors Property Resource. That's a product of the National Association of Realtors, and they provide also an AVM. They've got a good tie to real estate transactions all across the country, including our local market here, and they're able to come up with what they consider an automated valuation model. Zillow, of course, is the outlier of the three, and you can see that they go up and down, and sometimes they overvalue a property, and other times they undervalue. In this particular case, they're undervalued most of the time, with the exception of around that week 44, where it looks like maybe they might have agreed with the market analysis. But anyway, this gives you that overall value. And I'll just swing back to this graphic here for a second, just to give you an idea. This is the average of all of those: the CMA, the CoreLogic, the RPR, and the Zillow numbers there. So if we stretch this out, I just told you I've been evaluating this particular property for a long time, and I'm just going to go back to 2016, and you can kind of see where the overall value, this is the average value, the average AVM value of this particular property, going all the way back to 2016. And at the far right at the top, you see that little jump in activity. That's kind of what pricing has done and values have done in the Des Moines market, and then they kind of came back down. But if you draw a trend line over the top of that and you kind of look at that, you go, okay, well, things aren't too far off of where they probably would have been with or without COVID. Because if you look back to 2019, there was a period, or 2020, I should say, the AVM on this particular example was lower than the average trend line, but then it went above it in 2020. Things are kind of equaling out. So over time, just like the stock market, over time, home values tend to continue to rise. And if you weather the storms, the highs and the lows, and just look at this as a long-term investment, this is just a good example of how that can happen. Speaking of values, now this one is the home price appreciation numbers, and This is one of the most asked about graphics or analytics that I put out each year. It basically says, compared to last year, did home values go up or did they go down? Well, obviously, home values have gone up. Recent news has, all the news has been about home values have gone up by 22, 24%. Well, I don't agree with that. I think that the sale prices might have gone up, and the size of homes might have increased and things like that. I mean, it's just overall, if you look at new construction, yes, home values are going to be skewed. So the one thing I do when I create this appreciation calculation is, number one, is I knock out the new construction homes, because I'm looking at resale property price appreciation, not the price of new construction based on profit margins and rising material costs. So if you were to look at new construction, it would be a total different appreciation of value. On the left side in the red, you got two column charts. One represents single family ranches. The one next to it represents two-story homes, and you can see that it gives you the average sale price of each of those two types of homes. In other words, single-family ranches in the Des Moines market this past year were selling for on average about 284, 188 to 337 on the two stories. However, the appreciation of values year over year on the two-story was around 9.3% versus 6.4. So if you want to look at across the board, now, again, this is not a hard and fast number. It all depends, and that's the three words. It all depends on where your home is located. There are pockets in the Des Moines market and the Central Iowa market that appreciated at a greater level. There are areas in the Central Iowa market that did not appreciate at this level. Same thing on the condo townhomes on the right side in the green. 273,945 was the average price of a condo townhome ranch versus 202 for a two-story. These were all very, very popular style homes. These are the two most popular style homes we've seen in the past year. And if you just look at overall on the left side here on the red, overall, again, understanding that this is just in this particular analysis, if you wanted to say overall what were price increases in the market, just a little over 8% is where we were looking for existing homes. Again, not looking at new construction, just existing homes, and just almost 7.5% for the condo townhome marketplace. So take that for what it's worth. Understand that the only real way to determine if your home has appreciated in value is to probably either have a market analysis and or an appraisal on that specific property. And that's the caveat here, is that each property is unique and different. So this just gives you a baseline. Mortgage interest rates, the elephant in the room for 2022. You've probably seen this graphic if you watched my shows in the past. This shows you the difference between 2022 mortgage interest rates month by month versus 2021. And on the left side, you can see that the spread was not very different in January when they rose from 2.75 to 3.5%. But as the year went on, you can see that once we got around, it looks like around August or so, maybe July, the current mortgage interest rate for a 30-year fixed rate mortgage was pretty much doubled from where we were a year ago at this time. And that's been consistent through the end of 2022. So another way to look at those interest rates are to look at it on a weekly basis, again, starting at 3.22% to 6.42. And you're probably asking me, well, where am I getting these numbers? I've seen better rates than this locally. Well, you're probably right. But these numbers are the U.S. Primary Mortgage Survey numbers from Freddie Mac that are put out every Thursday. So it's the average across the nation. This is a national average mortgage rate across the country. And by using that national number, what that does is it gives us some more stability without the outliers. For example, credit unions, for example, may be offering lower rates as an incentive in the mortgage industry, but yet that might not be the prevailing rate. So if you're following a specific bank or credit union, you may or may not find lower interest rates, but that also doesn't take into account maybe what their loan costs are associated with that. So the best way that I found is to use the primary mortgage rate survey, which is a national number. And yes, it does tend to be a little bit higher, but it also kind of bakes in those average closing costs as well. If you look at the opposite sides of this, I'm going to set this next graphic up with this one. What I did was I assumed a $1,200 monthly payment, principal and interest only, on a 30-year fixed rate mortgage. And I said, okay, if it's $1,200 in January and you were able to finance that at 3.2% interest rate, where would your mortgage amount be? Now, this does not include taxes and insurance. It's just principal and interest only. I asked, where would that mortgage be on this particular scenario? And you can see at $276,700 in January, and at the end of December, that same $1,200 payment at a rate of just under about 6.4%, under 6.5%, would only fund a $191,400 mortgage. And so by doing those calculations and kind of overlaying the interest rate rise for the year and the purchase power as it goes down, you can kind of see that obviously it's an inversion or inverting graphic here. As the rates go up, the mortgage payment, mortgage amount goes down that you can afford with that. But all in all, from January through the end of December, we saw an over $85,000 purchase power drop. So this is one of the big reasons why I believe that we've seen fewer home buyers and fewer sale pendings on the market this year. Is home buyers just were not able to buy the same amount of money or buy the same amount of home that they could have earlier in the year. Doesn't mean that we didn't have sales and that home sales were not increased. It just means that this is just the average purchase ability from January to December there. Some of the market observations as we move forward here. We're going to look at, let's see, we're going to talk a little bit about the different types of financing and things like that here in a minute, but I thought it would be best to set up kind of, first of all, the cycle of real estate. We've talked about this during the year as well, but just to give you a review on this annual report, every real estate market goes through a cycle, and a typical cycle, at least in the past, has been around 10 years. It doesn't have to be 10 years. It's currently not 10 years in our current existing market. It's longer than 10 years, but it's kind of the average there. And there are 4 stages of a real estate cycle. You have your expansion period, which is kind of the where inventory levels begin to rise and buyer demand is on the rise. Home prices are on the rise. I mean, it's just rise. And other than time on the market, days on market tends to slow down or not slow down, speed up, and you end up selling homes faster. That's the excitement period of a real estate market. The second phase of a real estate cycle is the peak, and that's essentially where inventory begins to level off. Buyer demand is at its highest. Home prices are at their highest. The days on market are absolutely the fastest. We have just kind of gone through that in 2021 and 2022. We've seen this type of a market. I believe we are at the peak and on the way down into a slowdown, which is the third stage of a real estate cycle. This is where inventory begins to decrease. Home buyers end up becoming benefited from this, because as inventory, even though inventory decreases, home selection for home buyers, basically they may not have the same number of homes, but they have more time to go out and view those homes without feeling like they're going to have a home sold out from under them. We also tend to see more price reductions in this type of a cycle. And of course, the days on market begins to pick up and slow down a little bit there. The last period is the recovery period. It's typically the shortest period of the cycle. It's hits the bottom and then bounces right back up again. But this is when we hit our lowest inventory. Buyer demand is at the lowest. So think of sale pendings. And home prices are probably the most affordable at this stage, and days on market is the longest. Now, not to confuse the real estate cycle with the calendar cycle, but it kind of follows that as well. If you think about January, December, and January, those are really when our market is at the slowest, and you also find that home values are probably at their best pricing as we move into January, December, and January, early February. So again, don't confuse the cycle with that, but that's just kind of a comparison. So this is what it kind of looks like when you apply those cycles over a year period. And this is the last cycle we went through. I said our previous cycle was about a 10-year cycle. And in 2000, we were building in an expansion period. We hit the peak in about 2006. Of course, we had the mortgage crisis, that economic crisis, and that caused a slowdown, actually caused a recession in that particular instance. And we quickly recovered. We were back on the basic recovery as of 2010 on that. Now, it was painful a little bit, but it actually pretty well followed a real estate cycle. Beginning in 2010, moving forward now, and I've purposely stopped this at 2019, all indications were prior to COVID-19 hitting was that we were going to have hit our peak. Now, as you can tell, this would have been almost a 10-year, a 9-year cycle just to get to the peak portion. And that's why I say we don't necessarily have a 10-year cycle on these, but this particular cycle that we're currently in started in 2010, and all indications were that in 2019, listing inventory was starting to slow down. We were starting to see a lot of indications that we were peaking. However, COVID hit, and you can see that absolutely the opposite happened. It resparked the expansion period, and this can happen. You don't necessarily have to go from expansion, peak, slow down to recovery. Sometimes something can happen in a marketplace that will reignite an expansion. What was really not a peak, it was more of a stall because of COVID. We ended up with an expansion period going all the way again for another 3 or 4 years up until what I believe is currently 2023, late 2022 is where we've hit our peak. And we are probably now going to see a slowdown here in 2023. It's not going to be dramatic. It's not going to be long term. But I think by the end of 2023, we will have hit our recovery period, and we will be back up on heading back toward expansion in 2024. So some of the types of financing used in the marketplace overall, you can see that conventional on the left in the red column chart is showing you that almost 74% of sales this last year, 2022, used conventional financing. And if you consider cash a financing term, we just simply have it in our terms as a term, which cash is really not financing, but almost 13% of sales were purchased in 2022 using cash as opposed to any type of a mortgage. And that number typically is around that 8 to 10%. So I would say that probably just because of mortgage interest rates rising, we've seen that increase up close to 13% this past year. The remaining 3 government loan agencies, FHA, VA, and USDA, government-backed mortgage industries, made up the single-digit financing types, and then the balance under other, whether it's land contract or assumptions. Assumptions will be interesting to watch this year if rates continue to stay up where they are. I think we'll see some FHA and possibly VA mortgages that are assumable kind of hit the market, and especially the FHA market, you'll start to see some qualifying assumptions where someone can come in and as long as they qualify, take over a low 3% mortgage Might cost them similar to what it would cost for conventional, but in the grand scheme of things, if they can get a 3.5 or even a 4% mortgage interest rate on an FHA term, and because that's basically a way to get that rate today is to do an assumption. So contact a realtor if you've got some questions about that, if you're watching this as a consumer. So that's just something I kind of expect to start to see happen here as we move forward. Our back on the market inventory, this is where sales fall through. So I mentioned earlier that in the sale pendings that sometimes a home will go under contract, and for whatever reason, maybe it's a home inspection, it might be an appraisal issue, it might just be buyer's remorse, a home will come back onto the market. And the black line in this graphic, this weekly graphic, represent 2021. The kind of the reddish pink color there, whatever color that happens to be, salmon I think is what it's called. 2022, you can see that we started to see an increase in back on the market transactions as we move toward the end of the year. For the life of me, I can't figure out, I've tried to figure it out, why November, that first week in November, we had such a spike. The only thing that happened around that was the, coming up on the mid-year election. I don't know if that had anything to do with it. It certainly doesn't seem to be the case, but for whatever reason, we almost hit 50% that week. For the most part, though, we've been kind of pretty much on track with 2021. Price increases. This one's kind of interesting, where you'll see in a minute when we talk about reductions. In a typical market, and again, the black line was 2021, we would see, as the year begins, we would see a lot of new construction properties come in with price increases. And that was evident in 2021. You saw that in February, March, April, May, and a little bit in June, we started to see some price increases. Then we get to the end of the year in 2021, we saw November we had a spike, December we had a spike, and then at the very last of 2021, we saw an increase in pricing again. And I think majority of those increases are all due to new construction. As we get into 2022, you'll see that the second week in January, we had a spike. Again, that was kind of your typical price increases. But then that's about the time that mortgage interest rates began to rise. And really from about April on, the end of April on, we have really not seen very many, if any, price reductions over the norm, definitely under 50 from about June on each week. And that's, I think, just a pure product of the rising mortgage rates. We just aren't seeing price increases like we were in the past. Flip this over and look at price reductions. Again, the black line was 2021. From about May on, we have consistently seen price reductions hitting. And again, coincidence or not, November, we had a large spike of price reductions that first week in November. We've definitely seen that 2021 or 2022 was the year of price adjustments as we move forward here. The occupancy of homes, of when a home is sold, how many of them are owner occupied, how many are vacant, and how many are tenant occupied? Well, tenant occupied properties basically made up about 2% of the sales last year. Which is not surprising since with a shortage of housing, we've seen very few income properties coming on the market. Only 380 sales were tenant occupied last year. The large number of vacant might be a little bit misleading until you think about the fact that new construction is playing a part of that. New construction sales made about 25% of our sales. And of course, all of those transactions with new construction were vacant properties, obviously. So you might carve about half of that number out, and then you would see, about 25% of that 48 is new construction. The other 25% or 24% would be existing homes out there. So that's pretty normal in a normal market. I think right now we're just kind of not in that normal market since new construction is kind of prevalent there. A couple graphics here just to give you an idea of the most popular style homes sold. This really doesn't, it's just kind of interesting numbers here. Again, overall, the ranch style home continues to be the most popular style home sold in our marketplace, followed by 2 stories. Those make sense. Those are the most predominant builds that we've seen in the last couple hundred years of construction. We just typically see the ranches or the single stories and the 2 stories as your base homes. 1.5 stories, bungalows, split levels, split foyers, and down the line make up that balance. If you look at it from the single family existing homes, this is just carving out the condo townhomes and the new construction. It didn't change very much at all as far as percentage wise. Maybe a few more 2 stories and a few more 1.5 stories in the mix there. The same thing again goes for new construction. It is kind of interesting though in new construction that at 1,542 sales, this is probably one of the reasons why new construction pricing is kind of up a little bit, because if you think about it, a ranch style home in a new construction development requires a little bit larger lot than a 2-story. The footprint of the property is larger, therefore the lot size either must be larger, or you've seen it all where you look down new construction and you look down between the houses and they're so close together. Well, this is a product of that. They're trying to keep their costs down. But again, the most popular build out there is a ranch in the new construction field, followed by the 2 stories. I think I mentioned this a minute ago, but yeah, 75% of sales in our market this past year in 2022 were of existing homes. 25% of the sales last year were of new construction. And so it's pretty typical, I would say. The number of homes for sale, we'll talk about that here in a minute, but as far as the new construction sales, they make up about that 25%. And if you look at that from a month over month view here, this is combining the existing to new construction each month. You can still see that new construction sells about 250 to 300, maybe 200 to 300 homes each month, where in the existing homes it's a little bit more sporadic based on the time of year. So let's take a peek at the for sale analysis of the marketplace here. This is I don't know, let's call it a wave graphic or an area graphic, but again, the black line gives you a baseline as to the previous year, 2021. And this was the year where inventory started to grow in our marketplace. And you can see around May 1st was when we switched over and we actually started to increase our inventory levels versus the previous year. We ended up just a little over 3,000 on the market at one point, and our low at one point was around 1,600. We'll show you that here in just a second, but this just gives you an idea that things did change in 2022. This graphic, the previous year, would have been, completely with the previous year's inventory at a higher rate than what the current year was. So we definitely saw inventory rise. This graphic shows you the average going back to 2009. People go, well, what's a normal amount of homes on the market? Well, if you look back to 2009, in the yellow boxes there, that's the average for each of those years, with a high and a low minimum maximum number of homes on the market for each of those years. And obviously in 2019, when COVID hit, that's kind of when we saw our inventory begin to drop. We dropped as low on average as under 2,000 homes on the market in 2021. But I think we're on the track back. So 2020 was down, 2021 was down, but we're on our way back up here now in 2022. Looking back at this even farther, if you go back on this, not necessarily farther back to 2009, but just looking at the homes for sale graphic, one of the things you can kind of get an idea of is that at the peak this year, remember we said around 3,000 homes on the market, the last time we were at our low at 3,000 was back in 2018. And the idea here is let's start to knock off some of these high points now moving into 2023 here. So in order for us to hit around 3,500 homes on the market, which is what we did in 2016, we don't have that far to go. I think we will actually hit that pretty easily. I think we'll be closer to maybe that 4,000 homes for sale by the end of the year next year, at least at the high peak point, because you can see that it does go up and down near the end of the year. But sometime around the late fall, early winter time, we'll see that inventory peak close to 4,000 in 2023. This just again is that same graphic showing you the 4 different categories split out. All these graphics, by the way, are available at DesMoinesMarketValues.com. There will be a link on there for the video from today. There will be a link on there for all the graphics in a couple of places on there for you, so you can go back and pull all these down and evaluate them as you choose. Breaking down the homes for sale by category, again, 1,047, which is this year versus 705 from last year. We're up 342. We're up about 20 over our condo townhomes at the end of the year. 264 for new homes, and over the same period in 2021, and 160 on the condo townhomes. Weekly new listings. This is a graphic that represents the number of listings added to the inventory during a week. So this isn't the number of listings we have on the market. It doesn't, also not to be confused with brand new home listings. This is the number of homes added to the market in a weekly period. And the black line again kind of shows you 2021 versus 2022. A couple of areas there we did kind of outpace the previous year, but for the most part, you know what, this graphic here tells me that we didn't really add a lot of additional inventory to our listing database, and yet our inventory is growing, and we're going to talk about that here in a second, what the effect of that is. We'll refer back to this graphic, but all in all, we were pretty consistent with the number of homes that came on the market in 2022, and that might be hard to kind of understand or believe when you consider that our inventory has risen this year. Median pricing, we'll talk about that in a second. Median pricing, again, the black line is 2021, and if you were kind of to draw a trend line across that, you can see overall the median list price has actually started a downward turn, albeit very, very slight, maybe from 360 down to just under 350 at the end of the year. But it is a turn nonetheless. And if you look at these same categories by existing homes, existing condos, and then the new construction side of the items there, you'll see that really all of the categories, with the exception of condominium townhomes, list pricing has risen over the previous year. The new construction condo townhomes is actually lower than it was a year ago in 2021, and that had pretty much happened from mid-August on. We've seen that pricing come down. That's also been a good selling point for the new condo townhome market as well. That's one of the reasons why it's probably been as active as it was. With that said, now keep in mind, this is a graphic that I'm going to show you here from December 31st. This is a snapshot in time. This is just giving you an idea of how much inventory do we have, and do we have too much on them sitting there waiting to be sold. Well, again, this is one of those graphics that changes every single day. But overall, we were sitting with a little over 4.5 months of inventory for sale. In other words, if no new homes came on the market, how long would it take us to sell out all of our existing homes for sale? And in the case of all homes, it would take us about 4.5 months before we actually would run out of inventory. 2.5 months on existing homes, if you break it down by the subcategories, which means basically the existing arena, the existing homes and existing condos are both under 3 months of inventory, which tells us they're still in a very, very active and desirable market. So don't give up in the middle of the winter time. If you've got a home for sale, get it on there, make sure it looks good. And if it's an existing home, and it's priced properly, it's probably going to sell quickly. The new construction traditionally has a slowdown as we move toward the end of the year. And we're seeing that here with over a year's inventory, almost a year and a half of inventory of the new construction inventory. But again, don't worry, this will go down quickly as the spring market begins. One of my favorite graphics I produce, and this is one of them. I retooled the way it looks this year, but it basically looks at how fast, it looks at the list price to sale price by days on the market. In other words, the faster a home goes under contract or sells, if it goes under contract quickly, what's the list price to sale price percentage of that? In this particular case, homes that are on the market less than 2 weeks, under 14 days, on average in 2022, sold above the list price. This is existing homes, mind you, not new construction. This is existing homes. And so that tells you if you price it right and the home is of good value and it's a good market and a good place, you're going to, at least in 2022, you receive right at or a little above your offer price. So that means we still had some bidding out there. We had some price wars and things like that. Once you hit 15 days or 2 weeks on the market up to 90 days, and you start to have to make price reductions. So this number, this 93.9% that you see down, that's almost a 6% decrease, or a little over 6% decrease in list price to sale price. That just tells you that if you don't get it right in the first couple of weeks, you need to act quickly. Otherwise, you're going to start taking pretty much a hit off of your sale price. So this includes the price reduction as well as the final negotiated sale price here. So 15 to 90 days on the market, you're going to take almost a 6% hit off of your list price. We call that retail value. The first market we call market value there, which is kind of like, whatever the market dictates. Retail value, if you go into a grocery store or into a hardware store, there's going to be some things on sale every once in a while. You'll see some occasional sales. You think of it like that. What you want to do is be careful you don't get into the danger zone or the wholesale market. And in this particular case, it's almost the same thing. You can see that once a home is on the market longer than 90 days, even above the 181 days, you're taking a pretty substantial drop, over a 10% drop in your market. Now, that's actually still pretty good, because I know that in a normal market, we would occasionally see, 15, maybe close to 20% in that wholesale value there. So it just means that the fact that some people are still out there looking for bargains, but they're still just not, home sellers are not getting quite the top dollar. This same numbers looking at it from the perspective of existing condo townhomes. This is kind of more what we would have expected in a more typical market. Again, less than 14 days above list price, 15 to 90 days, retail value about 5% off, 7% off in the 91 to 80. That's getting in your danger zone. And then there again, there's your 15% off or 14% off in the wholesale in 181 days. So as you start to see homes on the market, this could give you a gauge of possibly where a seller may consider accepting an offer. Just a thought. That's just the idea here. So pending home sales analysis. We've looked at for sale. Let's look at sale pendings here. And this is a graphic that I hope that in 2023, this is the only time you'll see this, is in this report. Maybe at year end when we talk about looking back in the past again. But this is the inverted market report. The yellow mountain range in the back refers to or represents the sale pending counts, and the green mountain range in the front that overlaps that is the number of homes for sale. And in a typical market, which we're kind of in right now, I would say we're kind of in a typical market, we actually end up with more homes for sale than we have in sale pending, and that's kind of that supply and demand, wherever you see that yellow mountain range in the back going over the top. In fact, we've seen that for a little over the first half of this year. It's that seller demand and buyer demand and supply and demand at work here. And we've seen our sale pending slow down, and to the point now where we have more homes on the market than we have in sale pending. One last way to look at this is through this graphic, which basically looks at 2022 only, and you can see it's around week 31 or 32 that we did the crossover there. Again, at the end of the year, we're 2,794 for sale, 1,320 under contract there. The sale pendings. Now, remember I said, don't forget about this graphic I talked about earlier. This is the number of homes added to the market each week. And if you look at this graphic at the top there, that green graphic, and you look at it compared to the homes in sale pending, this is exactly why we are seeing more homes on the market, but not seeing more homes coming into the market, if that makes sense. Home buyers are just not buying the homes at the same pace that we have been used to in the last couple of years. The homes pending for all homes shows that in 2021, we are basically, what is that, about 2,000? Yeah, close to about 2,000 homes apart compared to the previous year. So homes are just selling at quite a bit slower pace. You can see how this looks across all of the 4 subcategories. Again, the caveat being the new construction condo townhome, although it is still also now changed, back to a non-inverted market there. For a period of time, it was it was an inverted market there for just a little bit. But homes in sale pending status there are a good indication of the speed of the market. And we're just seeing, the wider the gap from the previous year just shows that particular segment is a little bit slower. New construction, new homes at the top in the green are a good example of that. Looking at closed sales. Now, this is a brand new graphic. I kind of like this one. And I will continue to update this every year. This is a breakdown of Des Moines Area Association of Realtors sales across the state by county. And if you look off to the left there, the top 5 counties that we're selling from within our Des Moines market here, Central Iowa market, is Polk County, Dallas, Warren, Story, and Jasper. In fact, that category of those 5 counties make up almost 90% of our total sales in the marketplace. Marion could almost easily be added to that at 443 sales. That's a pretty busy marketplace for the Central Iowa market as well. But you do see that, as the counties get a little bit lighter, that just indicates that there are fewer sales out there. But I think it was 28 counties last time I counted it that we did not have sales in across the state. But we are reaching out as Des Moines Realtors, and ones and twos here and there. I know that a lot of areas are concerned that Des Moines is overtaking the state, but this just kind of proves that really we're not. It's just there's ones and twos of sales in different counties across the state there. So the bulk of the business being in the Central Iowa. So again, here's our homes for sale by year. This shows you back to 2009, kind of the trend that we were on. Again, remember I said I thought in 2019 our market was kind of going to peak a little bit there, but then COVID hit and went up. We are basically back up, still above 2017, 18, and 19 sales. Well, actually sales all prior to 2019. And this is broken down by these 4 subcategories. There's far left is all of them again compared to last year, but you can kind of see that existing homes are behind last year, as well as existing condos. New homes are still behind. The only category that's really ahead in closed sales this past year was new construction condominium townhomes, where we sold about 38, 39 more homes than we did a year ago. Median pricing, again, we kind of look at this. The important one to look at here is the black line 2021. Prior to about October or November, we were ahead of our median sale price, but as the year ended, it kind of fell back in line with 2021. A little bit of a peak there at the last 3 or 4 weeks of December, But that's probably a good sign that we're seeing some stabilization. Again, looking at it from the four subcategories, not too far off in the existing homes in the upper left-hand corner, but our median sale price on new construction in the green in the upper right-hand corner is up quite a bit over the previous year. So when is the best time of year to buy a home in 2022? This is kind of an interesting graphic. It's split out by all four of the subcategories. This is looking at existing homes only. This is the list price to sale price percentage. And in January, I think I said typically the end of the year or the first of the year is the best time to negotiate your price. And you can see that in January we were selling homes at about a little over 3.5% under list price overall. And as the spring market comes on, that kind of demand kind of dictates to sellers that they can hold out and find someone who's going to give them closer to list price. In fact, in June, it was above list price. But boy, look at that. With the price reductions in play and everything, you can see that at the end of this year, there was a lot of negotiation going on here. With the interest rates coming in to near their highest, we're seeing home sale prices around that under 5% off of list price. So looking at this from the perspective of existing condo townhomes, again, in the spring market, you started to see just a little bubble in April, May, and June where we were just above list price to sale price. So again, the limited number of these particular properties on the market really drove some bidding wars in there. But man, in July, it pretty much dropped right off quickly. So April, May, and June were the only 3 months we really probably saw those bidding wars. And then again, through the end of the year, back down to just almost 4% in December. Now, one would think with new construction, and obviously in new construction, with add-ons and things like that, typically a new construction home will sell for above list price. And that's kind of what we see right here. I've purposely covered December for a minute. But if you look, on average, by the time the concessions are added, whether it's upgrades to the property and things like that, new construction homes are selling at, or they're actually selling above list price. But as we get close to October, it's less than 1% increase over list price. Now, that's telling me that we're not getting as probably either as high of a sale price, or possibly some of the concessions are being added back in and it's not adjusting the sale price. But look what happened in the month of December here. We actually saw for the very first time that I can recall, overall on a monthly average, the list price to sale price percentage negotiated was less than list price on new construction. A couple of things that could be coming into play here are year-end inventory, builders trying to sell the last of their inventory that maybe is sitting there, or offering incentives to free up cash for the next year. So this is nothing I'm going to say is out of the ordinary, but it's just different. I haven't seen that. The condo townhome market did the same thing. Their margins are not too much over list price, other than November. I'm not sure what that spike was at almost 6%, but then in December, almost 5%. And I know there were several condo townhomes that I remember seeing that were offering price decreases. So it's not only just maybe a decrease in values, but you can see what's happening here is we're seeing some of the pricing at the end of the year for new construction condominiums actually drop. Okay, our last category here, we're going to look at the metro market analysis. This is the 22 communities that are basically connecting within the local metro of Des Moines and surrounding communities. And the first one we have here is the metro average list price, with Cumming being one of the larger, higher priced communities. Johnston has ranked right up there as well. However, Polk City and Clive are both kind of jumping in there. It used to be Cumming, Johnston, and then you got Polk City, then Clive. But the metro average list price, as COVID hit, we saw a lot of buyers moving out away from the center of the metro, and that's kind of what we're seeing there. So, oops, are we seeing this graphic here? I'm just going to keep on going here. As we move on to Metro homes sold, this is the units sold. So Ankeny came in at 1,810, West Des Moines 1,294, all the way down to Cumming. Remember, Cumming had the highest price, but yet they are selling the fewest, which kind of makes sense because they have fewer listings out there, but they also are at the higher price point. They're more of an acreage type community out there. The Metro average sale price. So again, Cumming, just because they were highest price, they're also selling about the highest price. Again, with the Des Moines East over there becoming the most affordable in our Metro at 137 average sale price. And the main players are kind of up and down the line. Days on market, existing homes, which if you think about downtown, now I'm thinking about Sherman Hills, area, that's probably closer to why they have such a fast-paced market down there. Those homes are in quite high demand down there, so they're not really downtown Des Moines, but they're technically part of the downtown Des Moines area there. Four days on market. On across the board, though, we've seen Carlisle being a pretty fast-paced community, again coming at the very end at 31 days, again just because of their inventory. You would normally think that maybe, well, Ankeny and Altoona and West Des Moines and are all in there. Clive at 16 days, just kind of fits that same mold. So 15, 16 days on the market. If you're looking at just existing condo townhomes, that was overall. Let's look at just the existing condo townhomes days on the market. Again, this changes just a little bit. Des Moines West, there's a new condominium development being built out there. So granted, this is existing homes, but some of the existing condo townhome markets out there are probably slowing. Des Moines West and Southwest, slowing just a little bit there. But on average, the condo townhome Metro days on market are around that 13 to 16. The Metro list price to sale price, kind of again looking at that. This is existing homes. Again, the bidding war downtown, you're seeing at 7% or almost 1% above list price. But for the most part, you're seeing that the deep discounts are happening. Des Moines East, Des Moines West, Polk City, at around that 2 to 1.5 to 2% on the Metro sale price to list price percentage. Existing condos, same numbers here. Again, review these at DesMoinesMarketValues.com and you'll get a good idea of that. So I'm going to wrap up with some final thoughts here, looking at what's ahead on the horizon for 2023. Our for sale inventory, I think, moving into this coming year, we're going to see inventory levels rise this year close to about 4,000 homes on the market. That would be my goal. If I were to make a goal, if I had anything to do with making goals, I would say I'd like to see us hit around that 4,000. Pending sales, I think activity is going to be strong through our spring market, which is pretty typical. We always tend to have this really strong, heavy spring market, and then it slows down in the fall. I think it's just going to depend a little bit about what interest rates do, which we'll talk about in a second. Closed sales, I think we'll see a similar year as to 2022, around that 15,000 closed sales for this coming year in 2023. I don't think we'll see an increase or a big jump in that. Days on market, I think that we'll expect to see homes take a little bit longer to sell in 2023, but not by a lot. I mean, we were used to 3-4 days on market in 2022 at the peak. I think we're going to probably see 3, 4, 5, 6 days on the market in 2023. Months of inventory will be low, probably in that under the $300,000 price point, only because that is the area that's most hurting for homes for sale, and homes in those price points pretty much sell as long as they're priced well and priced appropriately and in good condition. They're going to sell very, very quickly. I mentioned mortgage interest rates a second ago. I really think that we're going to see mortgage interest rates settle in somewhere between that 5 and 5.5% this coming year. And I think what that's going to do is it's going to give a lot of comfort and confidence to some people. For example, the buyer pool. I think that alone is going to help get a lot of these homeowners that are sitting on the side of the fence to jump off and get back into the mortgage or into the real estate market. So that's basically it. The show today, it's a long show. I understand that. It was a little over an hour. I will break it down into chunks on YouTube. You'll be able to go to DesMoinesMarketValues.com and you'll be able to pull out the segments you want. I'll do little bookmark timings on them. So if you want to jump in and just look at a certain part of this show, again, go to DesMoinesMarketValues.com or the graphics at Simply Des Moines Stats on Facebook there. Last thing is, be sure and please subscribe to my YouTube channel. Go to YouTube and search Simply Des Moines. You'll find me there. My latest shows will appear on the homepage of that. You'll be able to see the most recent shows as well as the previous shows as well. And with that, I just want to thank you all for your support and comments as I produce this every week. I look forward to coming back to you every week as we move into 2023. And be safe out there. Enjoy the weather as you can. And we'll talk to you all again next week. Thanks for joining me.